I know trading can be a very tiring thing, especially mentally. So I appreciate your time this afternoon. Hopefully it will be worth your time. You're going to learn something. We're going to go through and spend about an hour talking about fatal mistakes to avoid in trading, how to determine trade direction, how to determine trade targets, and just a number of different things related specifically to day trading. This is a sample of the day trading course that I'm presenting again this Saturday from 9 a.m. until 3:30, 4 o'clock Eastern Time. It will be presented, what you're seeing here will be presented in far more depth and detail with a lot more information, and you'll have the ability to ask more questions, and we'll go through case studies and things like that. This was presented 2 weeks ago on Saturday, so if you sign up for this Saturday's webinar to watch it live, you'll get the recording from the live one this Saturday, but you'll also immediately receive access to the recording from the last one. So you're going to get, it's the same material, except this Saturday, obviously, there's going to be more material because that's the way these things work. When I did these webinars, each time I do them again, I'm always adding things and changing things. Plus, the dynamic of each webinar tends to be a little bit different because you have a different crowd, you have a different people will ask different questions, so there can be different emphasis on different things. So that said, this is a sample of what you will see. If this speaks to you in any way, then you may want to consider taking that course this Saturday. The obligatory risk disclaimer about futures trading. I'll let you guys can read this. But it's basically that trading is risky, don't trade with money you don't have, a lot of things that should be common sense. And these things are true. These things should be heeded. I have been trading 27 plus years in front of a screen. I have 23 years of exposure and working with what was initially market profile and what is commonly referred to as market profile. It is important to emphasize I am not a market profile trader and my clients are not market profile traders. We are auction market traders. There is a huge difference. We're not trading, we're not married to a specific graph. There's no magic to a graph. The benefit of what we do is from understanding the market through a very unique worldview of how an auction market forms and how an auction market does what it's supposed to do, which is to facilitate trade. And we'll get into that in a little bit. Okay, there are several mistakes that I want to go over. And we're going to, I've got a case study at the end of this that's going to give you a specific trade setup that is recurring. So bear with me. These things are important. They do mean something. And this will all be tied together with that example. So fatal mistakes to avoid in day trading. This was 5 just off the top of my head. Putting the cart before the horse, overtrading, confusing randomness and positive expectancy, 1-minute myopia, and getting stuck on stupid. My personal favorite. Okay, putting the cart before the horse. The trading industry is unique in a number of different ways. It's unique in the opportunity that it offers. But it's also unique in that it is, in my experience, which is considerable, and I've been in various I've worn various hats within the industry. The industry does a very poor job of benefiting its customer, in particular the retail customer. Almost everything in the trading industry is designed for the benefit of the industry itself without a whole lot of regard to the actual results of its customers. And one of those, an example of that is that you very seldom see much emphasis placed on the need for learning to trade, or the fact that it is a process, or the fact that it is a profession similar to other professions that requires work, study, and experience and investment. It's just, it should be common sense, which we'll get to a little bit later also. You have to have a trade plan that includes a valid methodology and that yields a positive expectancy. If you do not have that, it's not if you're going to lose all your trading capital, it's when. And you can have a valid trade plan. You can have a trade plan with a positive expectancy. You can have a valid methodology on which that trade plan is based and still not be able to effectively execute it to the point that you have, you end up where you want to be, making a profit. The execution and the management of a discretionary trade model, a trade plan, is often overlooked. You've got to have both of these pieces. You have to have the ability to execute, and this is something that comes through experience. You want to get to a point, and those traders that have become successful don't have to think about what to do and when to do it and how to do it and where to put their stop and does this tick matter, does that tick matter. They just execute, and it takes experience. This is no different than most skills. Some of you, probably many or most of you, have been involved in athletics at some point in your life. And the example that I always use is that it's not natural to stand in a batter's box and have an individual throw a small sphere 90 miles an hour that can pass an inch or two from your face. But over time, you get used to the process, and you can stand in that batter's box and you can execute. But that's something that has to be acquired. Well, trading, it takes some time to be able to swing the bat, so to speak, in trading, even if you have the right bat and the right swing. Swinging it, in real time, it takes experience. That's the bottom line. Now, the learning curve in trading can be shortened, but it cannot be eliminated. Most of the trading education, quote-unquote education industry, is built on selling you an idea that all you need to do is buy this software, buy this indicator, listen to this chat room, read this book, take this course, and you're off and running. That's not realistic. I can't do that with you, and no one else can either. So you need to understand trading is a serious profession, and it has to be learned. Some ideas here that can put you well ahead of most people. And some of you may be sitting there thinking, well, I don't need this because I'm already trading. Just bear with me because a lot of people do need this. Sim trade, trade on a simulator. Almost all platforms now offer a simulator. And then if you get to the point where you're consistent with the simulator, you can show 4, 5, 6 months consistency with a simulator, then a couple of things. You should have good statistics that you can use to refine what you're doing. And then you can begin slowly trading with real money. The other way to do it, if you have money to spare, is to trade with money that you're just designating as part of your learning process, that you're just prepared to write off as educational expense. And believe me, if you start trading after a month or two of jumping into this, you're going to lose that money. I don't care. And it has nothing to do with intellect. Trading attracts extraordinarily bright, accomplished people. And trading also has one of the highest failure rates of any profession you can name. And I think part of the reason is you guys, some of you have heard me say this, is because the material on which most people base their trading is flawed inherently, but there's an unrealistic expectation, even if you're using valid material and you have a valid trade plan, about return and how to use leverage, which is what you're dealing with when you're dealing with futures. So you know, your money initially is better spent on learning to trade than on gimmicks that purport to be able to circumvent an understanding and experience and education that you inevitably will have to have. Believe me. You know, the group of successful traders is full of people who have tried this. You know, I did. Everybody, almost everybody does. You know, we'll spend a fortune before we ever make a nickel in trading, thinking that we can shortcut the process by buying special software, special indicators, special platforms. You know, now it's you know, special order entry. It's nonsensical if you really think about it. And the big secret about this is there isn't a secret. There aren't any secrets. The trading education and learning to trade is a lot like losing weight. It's not as easy or quick as we all would like it to be. I know how to lose weight. I know how to do it. Whether or not I'm willing to do it is a different story. I need to eat a little less, I need to drink a little less, and I need to exercise more. It's a real simple equation. But there is a huge diet industry out there that is going to sell me a pill or sell me a book, you know, that's some sort of magic. And there is no magic to losing weight, and there's no magic to learning to trade. You have to do something that's valid. So. The quickest way to get rich in trading is to go slowly, and I'm serious about that. If you know, if you're willing, if you're serious about trading, and I really only want to work with people that are serious about trading because this life is too short. But so what if it takes you 6, 7, 8, 18 months, a year and a half to confirm that you have a trade plan with an edge and that you can effectively execute it. If you can get to that point, so what if it takes you 18 months? I mean, when you then in short order, you will make up all the money that you spend in that 6, 12, 18-month period and more for the rest of your trading life. But if you try to truncate the process, instead of having a year of experience or 2 years of experience, you'll have a year of experience 10 times repeated with nothing to show for it. So you really want a valid foundation from which you can grow as a trader, and it's necessary that it's valid, or you are inevitably going to fail. And this is one last point that I wanted to make. You should be able to have some evidence if you like what I teach you guys. If you come to Alexander Trading, you're going to know in 3 or 4 months if this is right for you, or if I know what I'm talking about or not. And if in 3 or 4 months it's not clicking, you need to move on. That's enough time to figure out if anything that you're trying feels right, looks right, smells right, etc. I can put together an hour presentation on anything and make it look fantastic. I can take oscillators, I can take Fibonacci stuff, I can take astrology, I can take anything, and in an hour I can woe you with it. But within 3 or 4 months, you'll find out whether or not that stuff works. And that applies to what I teach and applies to what anybody else teaches. And something else, do not commit tens of thousands of dollars up front to anyone that purports to have some sort of magical technique to teach you how to trade. Get to know somebody. You know, I have people call me up and ask me about mentoring, and the first thing I tell them is, you know, sit in the room for a month or two. You may not like what I'm doing. You may not like me, you know, before you're going to give me thousands of dollars. Figure out what I'm all about, but do the same thing with the other people that you listen to or the other courses that you're thinking about buying. You don't have to commit tens of thousands of dollars up front to figure out if something feels right, looks right, and is probably going to work or not. So you do need to invest in education, but do be smart about it. Okay, over trading. This is a huge one. This is a huge mistake that especially intraday traders make. There are probably at most 3 or 4 different trades in a given market on a good day. A general rule of thumb is, and this is something that I try to apply to my own trading, if I have 3 losing trades in a row, I'm going to sit back and ask myself, now, are you taking good trades? You know, a losing trade is not necessarily a bad trade. A losing trade is a trade, you know, it's the cost of doing business. And I have sets of 3, 4, 5, 6 losing trades in a row. Every trader does. But if I have 3 losing trades in a row, it's time to, okay, now Tom, are you doing what you're supposed to be doing here, or are you trying to force something? So, you know, it's a good rule of thumb. If you're a discretionary trader, I think discretionary trading is the highest order of trading, but discretion involves judgment. So you have to think when you are trading, and you have to have checks and balances on activity so that you don't dig a hole during the day that was avoidable. One second here, guys. Okay, here we go. I had the question pane. I'm trying to keep an eye on questions, so if you have questions, go ahead and type them in. If it's relevant, immediately relevant, I'll answer it. I'll try and go back and answer every question at the end of this if I don't answer it immediately. And this is something else. Not trading is trading. And not trading is what you, as a day trader, should be doing most of the time. Not trading is a proactive, volitional activity that you need to master. It might be the most important skill you can master, is to not trade. There are infinite opportunities. You have a finite amount of money. I don't care who you are. Okay, this is another one. Confusing randomness and positive expectancy. Don't become a rat. If I put a rat in a box and I have a device that the rat can go over and depress, and he gets a pellet, food pellet. Well, the rat will figure out pretty quickly he gets a food pellet. Well, if I have it rigged somehow so that in some random way the rat goes over, depresses the panel, gets a food pellet, presses it again, gets a food pellet, presses it again, it gets shocked. Now it backs up a little bit, presses it again, it gets shocked, presses it again, gets shocked. Now we'll go over and sit in the corner for a few minutes and rethink this thing. But as long as that rat occasionally gets a food pellet, it will press that bar to the point that it will electrocute itself. Now, if I put a rat in a maze, in a box, and it goes over, it presses depresses the panel, it gets a shock, depresses it, gets a shock, it never gets a food pellet, it will stop. It will stop pressing that panel, believe me. Well, traders are a little bit like that rat. They get some setup gimmick, excuse me, and they start trading. and it works. They get 3 ticks. It works again, they get 3 ticks. It works again, they get 3 ticks. They lose. Now they lose 5 ticks plus the spread and the commission. Then they have another loser. Now they've got 3 winners and a loser. They're net down, but it feels good to have that winner. So we're going to use the same thing. We do it over and over and over. So eventually what happens, what that trader is doing, that trader is stuck in randomness. The trader has become a rat. There's enough positive feedback to keep that trader going, but the trader doesn't have what you have to have in order to succeed and generate consistent return on the trading capital. That's a positive expectancy. Randomness is randomness. Randomness is it's a coin toss, and it sells really, really well. But it doesn't work. Just because something generates winning trades does not mean it's something you should use to trade or that it has any value whatsoever. Adding random things on top of other random things does not equal validity or positive expectancy. And something else, traders, there seems to be an epidemic among traders thinking they have psychological problems. Now, I'm not sure. Maybe traders do. Maybe traders are a little bit different. My wife rolls her eyes and says that all traders are nuts. And when she says that, I remind her that her particular experience is not a valid sample. But so maybe traders as a group are a little bit nutty. But this epidemic of psychological problems out there that there must be, because there are more trading psychologists than there are traders at this point in time. And I think a reason for that is because people are trading randomly. And if you're that rat, when you press the mouse, which is the panel, and you don't know what's going to happen, yeah, you're going to be nervous about it. And you're going to come in every day. And as soon as you start the trading, you have a couple losses in a row, then you have a winner, then a loss, and a loss, and a loss. By noon, yeah, you're in a state of high anxiety. That's normal. That's called being normal. That's not some sort of psychosis. It's a psychosis if you can sit there all day long and lose money day after day after day and not be nervous about it. So the high anxiety thing that all traders have, that for some reason they feel they can just get fixed because it's a psychological problem, is not so much, I think, a psychological problem as it is a trading problem. One-minute myopia. The one-minute myopia became a trading disease in the 90s as we began to segue heavily into electronic trading, and we had transparency and access that we didn't have before. And there is a misperception that I'm decreasing my risk if I trade short-term charts, because on a short-term chart I can get in and have 3 ticks risk or 4 ticks risk. So, in the S&P Mini I can risk $62.50 or $75 or $125, and that's not much money. That's not much risk. Well, it is. If I do that all day long, I'm not actually decreasing the probability of losing money. I'm increasing the probability of losing money for a number of reasons. Number one, the shorter the time frame you trade, the bigger the cost, the trading cost, the larger the percentage of friction in and out I'm experiencing. Friction meaning the commissions, any slippage that you may get, the bid-ask spread, all of those things. So smaller time frames do not decrease the probability of you losing money. They actually increase it. Now, the larger degree time frames, and I'm talking intraday, we're talking about day trading, guys. The larger degree time frames are the time frames that are ultimately going to make or break the day trade. Now, if I'm trading intraday, the larger degree can be as small as the previous day's range, but it still is a larger degree than the trade that I'm taking. But ultimately, the trade that I'm taking in the intraday time frame is noise, and I have to recognize that. And the way to filter some of that noise is to be cognizant of larger degree time frames, and this is something else that helps me determine the direction of a trade. And ideally what we want to do is we want to execute a trade in a smaller degree of time with a target of the larger degree of time. And the trade example I'm going to show you illustrates that. Okay, getting stuck on stupid. As I said before, the trading population as a group is very bright, is very accomplished. You have academic high achievers, you have engineers, physicians, people with advanced degrees, people who have been successful all their lives. And for some reason, I don't know why, this is another one of those trading diseases that you get into trading. For some reason, people get into trading and the critical thinking switch goes off. I've never understood that. So think, ask questions. And an exercise you can go through is talk to yourself and pretend you're a parent, you're talking to yourself as a parent, and you're trading as a child. So you're sort of talking to yourself so that you can remove yourself emotionally from what you're doing and not be defensive about it. Pretend you're a parent and your child wants to discuss with you her trading, which is your trading. What if you look down at your results and that's coming from your child, what would you tell her? And then what would you ask her about it to try to get her to see what's going on? And then what advice would you give her? So this is a way to avoid getting stuck on stupid. If you think, it would seem to be self-evident that that's important, but if you think critically, you will avoid getting stuck on stupid. So be honest with yourself about what you're doing, about the results that you're getting, and what you're going to do about those results, and how you're going to improve them or not. Now, and this is important, and I've told many people this, never lose sight of the bigger picture. I love to trade. I'll always trade. It's a great profession. Once in a rare while, I'll have a client that will say, hey, Tom, this is great. I think it's super, and I'm going to give this, 6 or 7 months and see if it works out for me. If it's not, I'm just going to do something else. That's a rare person. Life is short. Be willing to say, this business, I'm going to go do something else. It's just not for me. That's okay. And I think that it puts you in a healthier state of mind that maybe you can't do this. Not everybody can trade for a variety of reasons. It's just a fact. I wish I could tell you, yes, everybody can learn to trade successfully. They can't. There are a number of reasons. So be willing to say, hey, you know what? I gave it a shot. It didn't work. Life is too short to drive yourself insane trying to do something that you can't do or you're not suited to do. Okay, this is the cure for what may ail you. Auction market principles. This is what we teach. Now, auction market principles are, it's a worldview of how markets work. It's a worldview of why markets do what they do and how they do it. It's very robust. It's as consistent and as objective as any form of analysis you'll ever see, and I will debate that with anyone, anytime, anywhere, whether it's fundamental analysis or technical analysis. And it is the ideal methodology for a discretionary, rules-based trading plan. Any market, any time frame. Now, discretionary traders, most of you guys, I presume probably all of you, are discretionary traders. You have to have definition, you have to have rules. And this gets back a little bit to the randomness thing that I spoke about earlier. Most discretionary traders are random traders, and they don't realize it. Being a discretionary trader is the highest order of trading, but if you are a random trader, it is a statistical certainty you're going to blow up. Okay, I'm going to show you a trade setup, and we're going to pretend this is the trade setup that you're preparing for your child. I have 4 children. I have 2, I guess you would call them adults. It's hard for me. I don't know if I'll ever be able to call my children adults. I have a 26, 25-year-old daughter, I have a 15-year-old daughter, and a 9-year-old son. And if I were going to teach my 15-year-old daughter one trade setup, this would be it. The market is an ongoing multi-dimensional puzzle, and your trade plan has to fit the puzzle at the point of execution if a given trade is going to work. Now think about that. And this is the very, very, very few methodologies out there do this. They don't fit. Their trade plan is sort of a one-trick pony, and usually they're trying to pound a square peg into a round hole. Well, when the hole is round, you better be using a round peg. When the hole is square, you better use a square peg. When the hole is triangular, you better have a peg shaped like a triangle. Auction market principles dictate how a market behaves and why. And what this does, it creates these recurring situations that are recognizable and tradable. They're logical, they're consistent. You can default back to a thought process that's linear, and you can ask the same questions about what you're doing over and over and over. You can have a checklist of things, and it's, again, it's a very consistent process. These auction market principles dictate how a market behaves and why. Now, these 3 points are basics of auction market concepts. The purpose of a market is to facilitate trade. Markets trade higher until they run out of buyers. They trade lower until they run out of sellers. Trade facilitation is accomplished by a price discovery process. Prices probe higher and lower to find relative value to the buyer and the seller. Now, this last statement, this is why markets tend to spend extended periods of time in ranges, and we call those ranges balance areas. They are areas of equilibrium where prices are generally as fair to the buyer as they are to the seller, and that's trade facilitation. That's the noise of the market is trade facilitation. That's the normal process of the market, and this is a process that's ongoing in all degrees of time, all the time. That's why it is an ideal day trade methodology, and actually in any time frame you trade. But it is a methodology that requires you to understand the auction process and what's going on. Once you do that, the ways you can apply it are limited only by your imagination and the depth of your understanding of the process. Okay, the ideal trade setup, excuse me, is based on an auction market reason for entry, and it will give you a logical invalidation point. Invalidation, a logical place to stop the trade out, and a logical target. Now, this, we use the term invalidate as opposed to stop for a reason, because we're trading market condition. this is not a methodology that says, okay, you go in here, you use a 5-tick stop, you put you put 2 contracts on here, use a 5-tick stop, you take one off at 3 ticks, and then you go to break even, blah, blah, blah. That's price-based trading. That's trading randomly. It will not work. It does not work. The stops that we use are dynamically determined by the market itself. Stops tend to be closer in less volatile markets. They tend to be further away in more volatile markets. Where they are placed is the exact same place in a volatile market as it is in a non-volatile market in terms of trade location. The distance between the entry and the stop will vary because of the increase in the volatility. But the target also varies. When you have to use a stop that is further away in price than in a more volatile market, the target is also going to be further away too. So the expectancy is always there. You're not risking 12 ticks sometimes to make 3 and 5 ticks sometimes to make 3. You're risking 1 or 2 handles or 1 or 2 points to make 7 or 8 consistently. That's the ideal trade, where you're risking 1 to make a multiple of 1. That's the most effective and easiest way to achieve a positive expectancy. Okay, now this is I'm going to take you through a trade setup, and this was today. Now, the other thing I want you to do, this morning I do, we have memberships, and I do a pre-market and I do a nightly report every day. I put today's report in the blog so you can listen to it. Now, if you click here later, you can hear what I had to say this morning about the trade setup that I would take. If this happened, this is what I'd be looking for. And I went through the entire process of explaining why I was looking for that. It was all based on auction market concepts and what typically happens, and this is something I've seen happen over and over and over and over and over again. My clients have seen it happen over and over and over again. So this was today's trading from here over here. So this morning when I was doing the pre-market, we were trading in Globex. And I said in Globex, and I'm going to show you some of the things that I discussed in Globex, that basically the ideal trade for me today would be if one or more of the indices took out last Friday's high and or the Globex high, and the other markets didn't confirm it, I would sell it. That would be a sell signal for me. Now, I didn't know if that was going to happen or not, obviously, because I don't predict. I'm just trying to follow an auction market. Now, this was information that was given in last night's report, the DBSA. Remember I said earlier, markets trade higher, and this is the auction market concept. I'm going to walk you through the entire concept of this day trade today. Markets trade higher until they run out of buyers. They trade lower until they run out of sellers. And then this, trade facilitation is accomplished by a price discovery process of prices probing higher and lower to find relative value to the buyer and seller. This is why markets tend to spend extended periods of time in ranges and balance areas. Now, we've had the mother of all bungee jumps off this low a few days ago. And then last Friday we had a levitation act where the market traded higher, higher, higher all day long. And the volume was extraordinarily light. And then yesterday we had some rotation, as you would expect, is normal in a market, and it was a very low volume day. So what is this telling me about the market from an auction market perspective? How can I analyze this? Well, markets trade higher until they run out of buyers, and if volume is getting lower, then there's less participation. Maybe obviously there are fewer buyers. Now, when I see this, it doesn't necessarily mean this market volume can't come into this market, but it's a heads up. That's one heads up for me as I'm analyzing this market the night before today, last night. When I'm looking at this market, I'm thinking about what I'm going to do today from a day trade perspective. I'll answer that question in a minute. The question is, are the markets manipulated by the big players in any way? Yes, they're manipulated by the big players in every way they can possibly manipulate them, but it doesn't matter if you do this. And I'll show you why. I'll tell you why. Let me come back to that. But the answer is yes, they are manipulated by the big players. And they always have been, and they always will be. Yes, there's nothing new there. Okay. This is the rally into yesterday's close. And my question to you is, do you notice any difference between this rally and this rally? These rallies are roughly the same duration in terms of time and also length. This was about 5.6%. Coming into today, this was about a little over 5%. So they were pretty close. But do you see any difference in these two rallies? Okay, I have some good answers, and there are some differences. Most of you are pointing out some differences, but from an auction market perspective, I haven't seen really what I'm looking for or what's significant from an auction market perspective that might help me the next day determine what to do and why to do it. Now, I'm going to give you a hint. Here it is. Trade facilitation is accomplished by a price discovery process of prices probing higher and lower to find relative value to the buyer and seller. This is why markets tend to spend extended periods of time in ranges, balance areas, even trending ones. Now, what I want you to notice about this rally is really this. This rally from here to here was it contained much more two-sided trade than we did, at least coming into today. You can see how the market rotated from, and I guarantee you if we went and we looked back in August at these days, you had heavy rotation from high to low during the day and throughout the day. And then you had days that would overlap the previous high, but the state of development, the fact that the market was developing up, was never violated. There's a general rule of thumb, you guys have heard me say this before. When a market is trending, when it's in vertical development, the previous day or the day before that's extreme tends to hold any retracement, and this is a wonderful example of it. So when I came into last night when I was looking at this, and I'm looking at volume, and I'm looking at the fact that we'd had very little two-sided trade, and that's unusual, I'm thinking, well, seems to me to be a smart thing to be betting on two-sided trade. So what would the ideal scenario be for a two-sided trade? And there's something else I wanted to show you that is part of the process. Let me find it. thought I'd made a slide. Hold on one second, guys. Let's see, because I think this is something you may want to may want to use. I left it out of the, here it is. I left it out of the presentation. I'll put this slide in there. Now this was another piece of the puzzle. This is now this is unique to the stock indices. This is not something you get in any other market, but it's basically their market internals. This is a moving averages. This is a moving average, a 3-period moving average of NYSE advancing issues, 10-period of advancing issues, and this is breadth. This is NYSE advancing minus declining issues, and this again speaks to the state of trade facilitation, the state of supply and demand, and obviously coming into today, we were going higher with less and less. Less and less breadth. So demand for stocks in general was waning based on this. Now, I also want to warn you, and I always do this, my clients will tell you, this is not the holy grail. You can't rote trade divergences. Divergences can be resolved one of two ways. They can be resolved by, signaling an imminent change in trend, or they can be resolved by erasing the divergence and powering higher, and none of this, it's a reset. And you want to make sure that in trading, when you're trading based on information like this or incorporating it, that you're not diverged from your money, because you can be very easily. These divergences can persist for long periods of time. You can't take stuff like this out of context. That's another reason that these auction market concepts and understanding the structure and the price action of the market is the default. All of this other stuff like this, and I want to emphasize, these are not oscillators. This is market internal generated information. It's directly related to the market. We don't use anything that's outside the market itself, and you don't need to. You don't want to. So, but this was another reason coming into today, along with volume, that one would have a logical basis for developing the idea. Well, if certain things happen tomorrow, I'm going to sell this market. Okay, so we come into today, and we've got lower volume. We've had an extraordinarily vertical market. We have less breadth, i.e. less general participation of the components of the market itself. So there are a lot of signals here that suggest, okay, well, what can we do about that? How can we trade it? And if you listen to that recording, and I really encourage you to do so, you'll hear me talk about ahead of time what might happen and what the ideal trade setup would be under these assumptions. Now this is these are 3-minute charts of the ES, the YM, the ENQ, the NASDAQ, and the Russell, the TF. And remember I said earlier, you want to avoid 1-minute myopia. I execute on a 3-minute chart or a 5-minute chart sometimes, but I am always, when I'm executing here, when I'm executing on a 3-minute chart, I'm trading this because I don't want to lose perspective. This is a 30-minute chart. So I'm executing on a 3-minute chart, but I want the time frame of this. And this morning in that recording, that if you listen to it, you'll hear me say, okay, the ideal setup is if the indices, take out Friday's high or the Globex high. I think in the case of the Dow, the YM, the Globex high was a little bit higher than Friday's high. But if that's taken out by one or more of the indices and it's unconfirmed by the others, that's a signal I'm going to sell it. And my target would be this area down here at a minimum. So that was sort of the plan coming into today, and that was, I discussed this. This was about, I don't know, before 7:30. And this is what happened. The market. This was 9:30. The market opened, and it began trading higher and higher towards the Globex highs. This is the ES. This is the YM. Here's the opening in the YM. Here's the opening in the Russell, and here's the opening in the NASDAQ. And so I'm sitting here, and I'm watching and watching and not doing anything, and we get this sudden flurry higher in here. And sure enough, the Russell takes off and takes out the Globex high. And I'm sitting here waiting to see if the others are, or if any of the others are going to do it, and they don't do it. So I sold this market. Now you may say, well, how did you get in? What did you look for? Blah 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 blah. It doesn't really matter. That's I talk about this in I'll see if I can't get you access to the other webinar I did 2 or 3 weeks ago before the Saturday presentation, because I talk about this a little bit there. But people obsess over the setup. How do I get in? Where do I get in? What do I do? Et cetera, et cetera. And it's really, you don't have to put that fine a point on it. If you see the setup, if you see the divergence form, and you see the market start to trade off, you enter. Now, where would your stop be? Well, your stop would be several ticks above your entry. Well, how many ticks? Well, more than 1 or 2, say 3 or 4. And something else, you can put it 2 ticks, you can put it 3 ticks, you can put it 4, 5, or 6 ticks. You're never, ever, ever going to be able to avoid the occasion where you get stopped out by 1 tick. It's a cost of doing business. And if the trade really isn't invalidated and you're stopped out by 1 tick, do you know what you do? You go back into the trade. That's how you cure the 1 tick thing. Don't sit there and whine and complain and moan that you got stopped out by 1 tick. Well, if the trade hasn't been invalidated, but you happen to have been unlucky on a spike, go back in. It's real simple. So this was the actual setup, and I'll show you. Well, let me do this. I think I have them all here. Hold on 1 second. Here we go. Now this is a screen that I keep up, so I can see, I can mark. These are the levels that I was watching. I want to see if they were taken out, and they were. So. And actually, there were several. Today was a great day to be trading the indices. It was one of the best days to be trading the indices we've had in a long time, I think. But in terms of the initial idea that occurred in that first hour of trading, you had the Russell here spike. Where's my? The Russell spiked above. This was Friday's high, so we spiked above it. And as the Russell was spiking above it, the NASDAQ is not following, the ES is not following, the Dow is not following. Now the really cool thing, if you look carefully here, is that you've got this large divergence, but you've got smaller divergences in this time frame, where you had the YM made a higher high here again, and it was the Russell didn't make a higher high, so you had this divergence with the Dow did not take out its Globex high, but it took out this little high, which was not confirmed even by the Russell. So you had multiple signals across time frames occurring. So to get back to my point earlier, and it's a fair question. Okay, well, where would I have entered that trade? Well, there are a number of ways. Some of it would depend on your comfort level and how you typically enter trades. If I think that's a divergence, I'm going to sell it as soon as I can hit the mouse button. And I don't care if I get 5.5 or if I get 6 3/4. This is a trade that doesn't depend. There's enough margin of error in this methodology that you don't have to be perfect. You don't have to execute perfectly. Now, ideally, if you see it soon enough, you get something around 1406 if you're trading the ES. And the same thing for the other indices. So if I see the Russell reversing and I see all of these markets reversing on these short-term bars, then I can enter somewhere in here, and my initial stop is going to go somewhere up here. It's going to be 3 or 4 ticks above this high. And then my job is to sit back and see what happens. And I sit there until the trade either reaches my target, is invalidated, or I have some auction market reason to consider getting out of the trade. And in this particular instance, clearly, we had a trade that worked spectacularly well, and you actually had, and I did this, and I think I would guess that some of my clients did as well. You actually had the market form another divergence with the NASDAQ finally came up and took out its high. The Russell sort of double topped against its early high, and then you had the S&P and the Dow comfortably below their early highs, their initial balance period high. So you could have added to the trade. This gets into sort of the nuances. There are a number of ways you could manage this trade. You could have taken partial profits along the way. If I'm in a trade and if I'm in a day trade and I see a sudden 8 or 9 handle move in my direction in a very short period of time, I'm taking some partial profit. Am I going to close the trade? Probably not, because I want to give that trade a chance to work, and that's something else. If this was going to be a down day, instead of closing my position, I wanted to maybe add to the trade, find some place to add to the trade. These are all things that you're not going to be able to do immediately, but you can immediately look for this trade and to define what this is to the point that you can immediately use it. And it happens every single week, probably 2 or 3 times a week. Put charts of all 4 of the indices up and then watch these things at extremes. In other words, against the previous day's high or low, and especially in that first hour of trading. And if you see one or more of the indices that's taking out that previous high, in this, to use as an example, there are other levels that you can watch, and see if the others are or are not. Those are divergences, and you can trade. Now, what's the logical target for a trade if I'm entering in the first hour of the day and I'm selling the high of the day? Well, the logical target is the low of the day, right? Well, how do I know what the low of the day is? Well, I don't know, but I can have an idea. And that idea is something, on a gross level approaching the 10-day average true range. So if I've sold this near the high of the day, I'm going to have an idea, that it's realistic for me to expect, I don't know what the average true range is right now, what, 10, 12 handles? So, that's sort of my target. Now, if I'm expecting the low of the day, am I going to get it in a nanosecond? Probably not. This is about as rewarding, as quickly rewarding a trade as you're ever going to see, frankly. That most trades just, they don't work this well, this quickly. Most of them are more like this, actually, where you enter here, goes in your favor, it comes back. Now, most people get stopped out here. Most people would be stopped out. They'd freak out and they'd make 2 ticks, or they'd be out at break even because they don't have the context that tells them why they should stay in the trade. But if I've sold near the high of the day, especially early, especially in that first hour of the day, there's a great chance I can hold that trade for whatever is the average true range of the day. Now, in this particular instance, and I talk about this in the video you can listen to if you'll go to that blog, my target for this trade was down in this area, and this target was actually exceeded by the NASDAQ at the end of the day. I think that's on another slide here I've got somewhere. Let's see. Yeah, here's the 30-minute chart. Now here's that initial setup on this is what it looks like on a 30-minute chart. And then you can see, this level was important. And this is the level in the ES, the NAS, the RUS, and this is the YM. So the YM came down here and took this out, the others didn't. So if it's late in the day, I'm a day trader, and I see this, I see these other, if I'm in one of these other markets, I'm not in the YM, and I see the YM taking it out, then I'm going to tighten my stopper, I'm going to take partial profits. And this was a day where I'm really scratching the surface, because this day offered an extraordinary amount of opportunity that you don't typically see. As I said before, you usually get 3 or 4 trades at most in a given market that you really have any business taking as a day trader. So that's a trade setup you guys should be able to use immediately. Now the auction markets lessons that were illustrated from this, and there were more than we have time to discuss. The best trades, the best day trades occur from extremes. Well, this today was an extreme from 2 time frames. Number one, it was an extreme from looking at what happened on Friday, looking at Globex. So it was that upper extreme. It was also an extreme time-wise, because I know that statistically the high or the low of the day is put in the stock index futures in the first hour of trading 65% of the time. So that's an extreme. Any time frame trade should include an objectively derived stop. In other words, I'm putting a stop where the idea is invalidated, not because I've worked out some sort of scheme where, I can trade risking 3 ticks and not go broke for the next 6 months or some nonsense like that. Any time frame trade should include an objectively derived target, and there are a number of ways to objectively derive a target. If I get a trade on early in the day at what has a reasonable opportunity to be the high or the low of the day, the target is the average true range for that particular market. Now, other targets include, and this is something we get into on Saturday, would include, key reference areas, high volume nodes, things like that. And then manage your trades consistently and objectively. But to do this, you can't do it unless you have something, a worldview of the market that allows you to be consistent and objective. And these concepts certainly do that. Trading market condition is by far the most effective way to trade. It is trading on a different plane than 99% of the people out there are attempting to do. It's an advanced way to trade. You can begin slowly with basic things, and I just showed you something that you should be able to understand, and if you listen to this a couple of times, you should be able to implement that tomorrow. Our methodology is based on auction market principles, and it facilitates all of the above, all of these lessons. And this is one example of a trade setup that's recurring, and it's sort of unique because the stock indices are somewhat of a unique animal, because you have internal information that you don't have available in some of the commodities and other futures contracts, because of you have internals and breadth, and then you have, because they are so highly correlated, you can watch one to see if something is being confirmed or not, and those are great signals. Okay, this Saturday I am giving the day trade course. We start at 9. I'll be through by 3:30 or 4. And you will see what you just saw in more detail and in a lot more contracts. I think we used examples in crude, gold, the euro, some of the currencies, some of the grains last time. We'll do the same thing this time, talking about different setups and trade management and things like that. So if you're interested in this, please go to the website and sign up. It's Here, I'll show you the website. It's alexandertrading.com. It's just go to alexandertrading.com and click on this, and that will give you the details. All right, let me look at your questions, see what's going on. Jim Picaro, how are you, Jim? Troy, Jim, I'm in the room almost every day, part of the day. I wasn't today because I was busy doing this, but Troy runs the room, and for those of you that don't know me or Alexander Trading or Troy does an incredible job. Troy does a better job than I think I could do. Troy follows the methodology and understands it as thoroughly, I think, and applies it as consistently as it can possibly be applied. Steve Lewis, you say, what blog are you referring to? I'm referring to my blog on the website here. I'll show you. If you go to alexandertrading.com, there's a blog here. I've got a members blog, but I have a public blog. If you click on public blog, and then you click on the latest entry, and then you click over here, you will hear the pre-market analysis that I did for the Alexander Trading members for today. And it sort of sets up what actually it worked out perfectly. And believe you me, they don't work out this way every day. Trust me. This one did. This was pretty textbook. But you can see, Steve, there are, there's a lot of information in here. You can go through here and look at past analysis, and you can see for yourself how it works, or you can see for yourself if it doesn't work. But I think you'll see something that's consistent and objective. Someone says, how much money is needed to start trading with one contract of the index? The objective of profit is very small. The objective of profit is irrelevant, frankly. The first thing you need to do before you trade any money is to learn how to trade, and it's particularly important if you have a small amount of trading capital, not to trade it until you learn to trade. If you come in with $1,500 or $2,000 because a broker is going to give you $500 day trade margins, you just write him a check and send him the money, and don't waste your time. You're going to lose your money. I wish I could tell you otherwise. I don't mean to be harsh, but that's true. Steve, you say, are you saying you got lucky? There is an element of luck in this. Today was a lucky day, Steve. Yes, it's set up perfectly. I consider that. I consider there to be an element of luck in that. Let's see. Tom, when you look for and get a divergence at an extreme, do you have a preference for which one to enter, the strong one that might catch up or one of the weak ones? That's a great question, Kim. No, not really. No, I don't. I haven't. Maybe that's something I should go back and analyze, but I haven't, and I don't. And frankly, if the trade is going to work, they're all going to move in the direction that you think. Someone asked the question, can you begin with $5,000? Yeah, it boils down to, if you're trading with $5,000, you're going to have to be extraordinarily disciplined and patient. And I'll get back to this. You don't trade that until you've proven, or you have some objective reason to believe that you can trade it and make money. If you start with $5,000 thinking that you're going to learn to trade and you're not going to lose your $5,000 before you learn to trade, I promise you, you will lose your $5,000. Let's see, I'm going back and I'm looking at other questions. All right, I don't. Oh, okay, here's one. Are the markets manipulated by the big players in any way? Someone asked me this at the beginning, and my answer to that is absolutely, every single day to the largest degree they can get away with it. But that's okay. It doesn't matter. The big money is the big money. They move in and out of the market, and when they do it, it creates, they still have to move in and out of these markets, and the laws of how an auction market trades are immutable. And I'll show you an example. What I mean by that. You know, there's only one party that can move a market directionally and then can sustain that move, and it's the big money. Markets become one-sided. They trend when one side or the other overwhelms the other side. It's not you or me putting on a 2-lot or 10-lot or a 50-lot. It's somebody coming in, and they're overwhelming the market. And that's what happened here. Now, when I see something like this happen, I've got a couple of different choices. Hopefully, you know, I was watching this balance area and I bought the breakout and I participated. But if I see this market trending, the further it trends without any sort of rotation, the less and less of an edge there is at a given point in time, and there's nothing for me to do. So I have to sit there. You know, if I see that, you know, if I, you know, got up to get a cup of coffee and this thing, when I come back, this thing's up 8 handles and I'm not on board, I just missed an 8-handle move. That's just life. I have to wait until there's something objective that allows me to enter. And so in general, what I'm looking for is something like this. I want to see a two-sided market. If I have a two-sided market, then I have a means to evaluate, a means to define an entry and a target, and a means to determine what invalidates my trade idea. If I just decide the market is overbought and sell here because, you know, my super day glow oscillator is buried at the top at 100 and running along, and I say, you know, it's overbought, and I sell here, then I'm sort of, you know, I'm standing in front of the train expecting magic to bail me out, and that doesn't work. On the other hand, if I buy it here, I don't really have a great place to put a stop because the market is already in this time frame. It's already probably approaching something resembling, you know, a fairly significant part of what would constitute the average true range for an entire day in a couple of hours. So if I go long here and don't fight the trend, I could very well be exposing myself to, you know, it goes 2 ticks higher, and then what it does, it stays in a range, you know, a 4-handle range like the S&P will tend to do these days for 6 hours and drive me insane. So I want to be entering at extremes. I want to be entering here. This is an inflection point. When I entered this trade in here, one of 2 things was likely to happen. I was going to be spectacularly wrong, and I'd get stopped out here as the market was going like this, or I'd have a good trade and it would work out. Now, the reason I chose the direction I did, I explained. You know, it looked like we were running out of buyers, there were divergences here, breadth was less, etc. So that's why I chose the direction I did. You know, there are times where you want to buy the breakout instead of fading something that might be breaking out. Scott, you say, what is the link for my website? It's alexandertrading.com. Just go to www.alexandertrading.com here. You know, this is market profile, auction market day trading course. Just click here. And this will talk about it, and then click here to buy it. Now, you know, I want to tell you this again. If you sign up for this course, you're going to see it live. You'll get the recording of that presentation, but you're also going to get the recording of the presentation I did Saturday a week ago. So you're going to get 2 presentations. It is the same material. You'll find that it's different, and you're probably going to get something out of both presentations, because while the material is the same, I don't read from a script, and people ask questions, and that tends to direct the emphasis at a given point in time, and different things become emphasized on this Saturday that maybe weren't emphasized the last Saturday. So, guys, questions? Observations? Comments? Okay, guys, have a good evening. Thank you again very much for coming in. Let me answer this last question, and this is Scott says, have you changed your trading at all due to high-frequency trading? No, I haven't, because high-frequency trading is basically hyper nanosecond, millisecond computers taking advantage of the bid-ask spread in extraordinarily short time frames. And one of the things that you heard me implicitly say here is you don't want to trade that game. You don't want to be trading 3 ticks to make 3 ticks. If you are one of these guys that thinks it's easier to put on a 10 lot and make 3 ticks with a 3-tick risk because there's less risk or it happens more often, you're delusional, and you are effectively putting yourself in the way of that high frequency noise, and you're going to get destroyed. What we're doing, what I'm doing here, I don't care. They can high frequency trade all they want to. I'm trading at certain trade location, and these trades work now. They worked 5 years ago, 10 years ago, and they worked 80 years ago. So guys, I will see you later. Thank you very much for coming, and I hope you guys will, some of you will take this course on Saturday, or take a look at our membership services. We have, I think what we offer the trader for the money is the greatest value you're going to get. So please go to the website, check things out. So you guys take care, and I'm going to sign off with that.